Hi folks, so today is 23rd of January and we shall see the editorial page of the Economic Times newspaper. So this is the article which we'll be targeting today. The dip has its upside. So as we know that the rupee is sliding against the dollar. So the whole editorial is about that. On January 13, the rupee recorded its sharpest single-day decline in nearly 2 years, finishing at a historic low of 86.62 rupees against the dollar. Numerous commentaries have expressed concern. A weaker rupee implies higher import costs, which could lead to a widening of current account deficit. A widening current account deficit will fuel domestic inflation by raising imported crude oil prices. Now, this could have secondary effects, including a decline in forex reserves and foreign institutions pulling out of their stock market. So, depreciation of the rupee against the dollar is not recent. An analysis of the long-term data suggests that the average annual depreciation of the rupee was 0.4% between 2000 and 2004. However, the depreciation accelerated significantly after that, with the rupee going down on average by 3.4% annually between 2005 and 2014. This trend remained largely unchanged between 2015 and 2025, with the rupee dipping on average by 3.5% annually. So in the whole paragraph, it says that on January 13, rupee saw its, rupee as its was at the lowest of historic 86 rupees point 62 against the dollar, and despite that, like numerous expressions have been concerned. Okay, now the author says that the weaker rupee can imply higher cost and it could lead to a widening of current account deficit. And this current deficit, because since we have to import oil and then we'll have to pay the forex of the foreign currency through this reserve only. So this will widen. So current account deficit will widen at the expense of foreign exchange reserves. So this could have secondary effects, and it could also decline in forex with the investors pulling out their money. Now, depreciation of the rupee against the dollar is not recent, and analysis showed that between 2000 and 2004, the rupee used to depreciate by 0.4%, but now the average since 2005 to 2025, it has been declining at the rate of 3.4 to 3.5% annually. Okay. So there are two reasons for rupee depreciation: inflation. If domestic inflation is higher than the US inflation, the rupee is expected to depreciate against the dollar. So it says if the country of India is having domestic inflation which is higher than US inflation, the rupee is expected to depreciate against the dollar and asset market approach. So this suggests that the value of the exchange rate depends on how the flow and inflow and outflow of capital into and from the domestic economy. So historically, the US has a lower inflation rate than India. Much of the differential in inflation rates between the US and India can be explained by labor productivity. According to International Labour Organization estimates for 2025, India is producing an output of $25,431 per worker, below America's average of $1,53,446 per worker. So additionally, with Donald Trump in the saddle, fund managers are pulling out of the Indian market, hoping that American assets and the dollar will yield greater returns. So people are pulling out their money. And foreign fund managers sold equities worth rupees 1,13,858 crore in October, with an additional of 41,870 crore of equities sold in November 2024. So depreciation of the rupee is likely to continue. One shouldn't be overly concerned unless the annual rate of depreciation exceeds 4%. So now it is 3.6. Now, if it exceeds 4%, it shouldn't be much of a concern because people are pulling out their money, and the inflation in the domestic market is also soaring high compared to the uh, dollar. Okay. So a weaker rupee may not necessarily boost our merchandise exports. So as we know, if the rupee is depreciating, the exporters will be benefited. But here it says may not boost the merchandise exports. A look at major tradable export items suggests these are income elastic. They tend to perform well when there is an upsurge in foreign income. In case of India, there is a change in composition of exports from price-sensitive items like leather, footwear, dairy products, and beverages to more income-sensitive items such as refined petroleum products, iron and steel, chemical, and machinery. For example, the share of refined petroleum products in export basket increased from 2% in 1993 to 21% in 2023. In fact, India is now the second largest exporter of refined petroleum in the world, with exports valued at $85 billion and a global market share of 12.6%. Although the weakening rupee helped improve the trade balance between 2000 and 2014, evidence of such a relationship has become increasingly weak in the years following 2014. So, the fear that a weakening rupee will increase India's trade deficit may not be accurate. It says that the fear that a weakening rupee will increase India's trade deficit may not be accurate. This relationship between exchange, because we can see here from the data that the export has had increased from 1993 to 2023 based on the export basket, whichever items are there in the petroleum products. So the relationship between exchange rate and merchandise trade deficit is becoming irrelevant. Okay, due to shift in Indian exports from price sensitive to income sensitive items, a prolonged Russia-Ukraine war, and the onset of weak global economic growth, especially in the Eurozone, led to lower demand for income elastic items, which make up a significant portion of India's export basket. So in China, India's largest trading partner, GDP growth rate is likely to slow down from 8.1% in 2021 to below 5% in 2025. Trump's tariffs could pose a challenge for India's exports too. Tariff may also reduce the US trade deficit, potentially leading to further appreciation of the dollar. So it says that further appreciation of dollar might take place because GDP growth will not be likely as it was in 2021. So in 2025, we are expecting just 5% or below 5% GDP growth. And tariffs may also reduce the US trade deficit, potentially leading to further appreciation of the dollar. On the flip side, Trump facilitating end of the war in Gaza and potentially resolving the Russia-Ukraine conflict could lead to softer crude prices, higher global income, and a positive impact on our income-sensitive exports. A weaker rupee will make India an attractive destination for businesses as Indian labor and capital become relatively cheaper. The rapid growth of GCVs in India is a testament to this. So in 2022, India became the first country to receive over $111 billion in remittances, nearly 2.2 times the $49 billion in FDI inflows. The weakening rupee is expected to boost India's software exports, while India's largest import category, mineral fuels, oils, and bituminous substances, is offset by service exports. This contrasts with other South Asian countries facing long-term growth challenges due to declining currency. So we're still at a better position, is what the author is saying, compared to South Asian countries. And uh, in 2022, it was the remittances value with $111 billion. Okay, nearly 2.2 times the FDI inflow. And the weakening rupee is actually boosting the software exports. And while India's large import categories are all these petroleum products, it is offset by service exports. So it will be compensated by the service exports, the service sector industries. So that is all it says, that maybe the rupee will slide more than what it is currently at. Thank you.